before we kind of get kicked off. Yay, welcome to the first official Lunch and Learn of 2020-2021. Cash Day just happened for us a couple weeks ago as an accelerator member. And I thought John would be a great kind of, because we're going to do these once a month. And they're going to be in topics relevant to what our growth days were. And I was talking to John at an event, and I thought it'd be great for him to kind of come in and share a little bit about, like, all right, we've got cash, we've looked at our kind of income statements and profits and loss and all that kind of good stuff. And the last call we really want to get is from the government saying, I'd like to learn a little bit more about you. So if I can help people not have that call, I think that would be awesome. So there you go. With that in mind, John, I'll let you take it away. And then as you guys have questions, kind of throw them up in the chat window, and then I will kind of take them from there and we'll kind of pepper them as we go.
Good. All right. So my name is John Milikowsky. Many of you guys know me. I've been in EO since last year. I'm currently the finance chair for EO San Diego. And I've been a tax attorney for 11 years. Well, I've been an attorney for 18 years, did a lot of business litigation, ran several companies, and now have, for the last 11 years, have my own law firm doing tax litigation. So what is tax litigation? Tax litigation is, a lot of people really don't understand what the difference between a CPA and an attorney is. So CPAs prepare tax returns. They also give a lot of advice on different transactions, how to report transactions, the tax consequence. We get into the gray area, which is different than CPAs. We give legal advice. So if a CPA says, hey, should I report a bunch of these 1099 incomes that I had when the bank discharged my loan? We get involved and we'll give an opinion as to whether it should be reported and how it's going to be reported. It's really intended to minimize the risk. Now, we also get involved if there's an IRS audit or an EDD audit or a criminal audit. We do a lot of criminal investigations as well as civil. So either side of the spectrum for any type of tax in California that's being disputed by the government or the federal level. All right. I thought there was an interesting quote I saw from Albert Einstein. Is the hardest thing in the world to understand is the income tax. And I thought that was kind of cute because such a bright guy and still had trouble with taxes. And I remember meeting an ambassador to the US from Israel, and I'm trying to remember his name, it was several years ago. And he said, you know, the only thing that scares me in life is the US government IRS. Beyond that, I really don't have any other fears. And I thought, you know, kind of an interesting thing because we deal with them every day. So it becomes commonplace for us. A little bit about my background. As I mentioned, I've been an attorney for 18 years. I've probably had over 300 audits with IRS and state of California, a mixture of criminal and civil, mostly on the civil side. But we have some really complicated things, and hopefully we're going to go through some of that today. One thing that's not mentioned in here is in my bio that in 2009, I presented a proposal to the Congressional Committee staff members, as well as US Treasury and IRS, to try to change the tax code really to help people out. And it had to do with penalties. So it was an interesting process, and we learned a lot about how closed the government is because they're afraid to open the door just a little bit, and they're not really sure what kind of a domino effect and how many other loopholes they're going to create by that. So, okay, so really the discussion that I'm going to have today is centered around how to minimize risk, because a lot of people, maybe with a show of hands, how many people have a CPA to prepare their returns? Yeah? All right. So maybe half. So when you are getting your tax return prepared for your business, you're going to give them your bank statements, maybe, maybe not, your financial statements, and the CPA is going to go through that. And CPAs come in all different flavors. Some of them will just have a discussion with you and report whatever numbers on your P&L on your tax return. Other ones maybe do a deeper dive. But I will tell you that the majority of audits that we do, every single company, very few companies that I've had, and I've had over 300 audits, which is a lot, very few companies have perfect financials. So what are the common mistakes? Well, people misclassify an expense. People include a personal expense. People deduct something entirely when it should be amortized maybe over a 5-year, 10-year period. So what we're going to teach you today a little bit is about how to look at your tax return and confirm some things. Most important is income. So number one on our list here, 3 things to do before you file your tax return. And I mean, before your CPA files the return. Get the draft return, and I do the same thing, and it's painstaking, but verify the income. right? So look at your bank statements, and we do what we call a bank deposit analysis. Every single government audit we have, whether it's EDD, relating to independent contractor misclassification, or an IRS audit, or a criminal investigation, I always go through bank statements. A quick example, I had a client who 4 years ago came to me and said, look, I filed a return, I got an audit, and I said, not a big deal. So I got his bank statements and I did a bank deposit analysis, which we add up all the deposits every month, okay? And then subtract out things that are not income. So insurance claim, checks from your insurance company when you have an auto damage or something gets burned or destroyed in your work and insurance covers it. That's not taxable income. Transfers between one account and another, is not income. You remove all these extraneous deposits or credits to your bank account, and whatever's left over is what I call true income. So then we compare that amount to what's on the tax return. And I can assure you 100% of the time, IRS does the exact same analysis. So before I ever meet with the government, I go through bank statements. The bank statement is like your fingerprint. I can tell everything about your life, especially on your personal bank statements. I can tell where you eat, whether you eat healthy, whether you don't, whether you buy a lot of alcohol, whether you see movies, what you buy with your debit cards. I can tell a lot about a person simply by looking at their bank account. And so IRS will do the same thing, but they're mainly focused on the income side. That's a really important thing for them. The second thing we do is we review the general ledger. So I don't know how many of you have experience looking through general ledger, but a general ledger is basically a summary of all the transactions that you've entered in or your company has reported for that particular year. It's basically like a book. So you're going to have a lot of your income items in the beginning, and then it's going to go through the expense account in the same order that you set up your chart of accounts, right? All your expenses. So your payroll and your cost of goods sold and things like that. I go through the general ledger, and if you become familiar with it enough and understand how it's structured, it's not that hard, but you can see, especially if you're not reporting and you're not inputting the information to your accounting system, you can see exactly what's being reported. So I had a client who was reporting $800,000 of gift cards that she was giving to for referrals, right? So somebody would refer her a client, she'd give a gift card, and it was $800,000 for the year. Well, she reported on their cost of goods sold, which is incorrect. It's maybe advertising or marketing. Her argument was that if she didn't buy the gift card, she wouldn't have gotten the business. So it's a cost of doing business, but it's actually improperly allocated or improperly reported. And it's actually, these gift cards were over $25. So the gifts really were not gifts. They were almost payments. So you get into some interesting things. So look at the categories of what's being reported on your tax return, match it, make sure the same numbers in your general ledger, find out exactly what makes up that number. What makes up your cost of goods sold? What makes up your payroll? All of these things. The third thing is if you have any complicated transactions, IRS is really after a lot of interesting things now. One particular thing is captive, micro-captive insurance. And it sounds complicated, but there are some people that are involved in it. So IRS actually on their website lists all the things which they consider to be suspicious or potentially abusive transactions. You could look at that list and say, wow, I actually do have this transaction. Maybe I should talk to my CPA. Under some circumstances, you actually have to tell the IRS that you are involved in that transaction because they don't know. All they have is a number on for a transaction that's on your return. They don't know where the transaction emanated from. So some circumstances, you actually have to tell them what the transaction was.
I don't know about that lady's business, but $800,000 in gift cards, I would think that she drove a lot of business as thank yous for that. Wow.
Yeah, it got into another area because for the Contractor State Licensing Board, they don't allow in the construction industry to pay a referral fee. It's actually against the law. So then the concern was there, is the IRS going to refer her to the local state agency, which could be a criminal matter. So it's a lot of interesting things come out of that, but that was simply a review of her general ledger.
Wow.
Yep. So what is IRS currently focusing on today? Two main things that I could tell you that are really simple things: high earners, non-filers, and tax shelters. I mean, there's many other things they're looking at: payroll, unpaid payroll tax, things like that, and of course SBA loans that maybe didn't qualify. But high earners, non-filers, I go to a lot of conferences where IRS is a panel member or members, and they talk about this quite frequently. And there's a government accountability report. The GAO is an independent, I guess you can call them an agency within the government, and they do studies on different departments to see whether they're being efficient, whether they're being effective. And in 2019, they came out with a report, and you can download this on the internet if you want. I'm happy to send it to you. They determined that IRS was the amount of high income non-filers that were being audited was really down quite a bit. So, and they had scaled it down. So in 2010, IRS audited 3.5 million individuals and 4.3 million businesses who were non-filers. That means they didn't file a return, so IRS opened an audit. That's 2010. 2018, those numbers dropped down to 800,000 for individuals and 400,000 for businesses. It was a 77% drop for individuals and a 91% drop for businesses. That's significant. So now, the last couple of years, IRS has been very hungry for that. And those are low-lying fruit, guys. If you didn't file a return, IRS cares more about you filing a return and not paying than not ever filing, because if you don't file a return, you're not on the grid, and they have no clue as to what's going on. And it could potentially lead to a criminal investigation if there's enough money involved. So the penalty, by the way, for not filing a return is 5% per month of the taxes you owe. Maxes out after 5 months, so 25% in addition. For not paying, it's 0.5% a month, and it maxes out at 25%, so that's over 50 months. So they care more about non-filers. Tax shelter, I won't go into too much detail, but if you want to go to the IRS's website, I kind of did a little screenshot there. You could look at recognized abusive and illicit transactions, and you could look at what they consider to be a tax shelter, things that you maybe were aware of. But a tax shelter is basically a transaction that is intended to reduce taxes through one or more transactions, but really doesn't comply with the tax code or the true intent of the law. There's a lot of people out there, CPAs and advisors, who will put together these beautiful plans and say, hey, we have a structure that'll save you X amount of dollars. And they have an opinion from a tax attorney. So if you enter that transaction, IRS later determines that that was an abusive transaction, and you say, well, hold on a second, I have a letter from an attorney. Well, that letter is really not going to work because it came from the same entity, the same organization that's selling you the transaction. So you really need to get, if you ever enter into these transactions that you think might save you a lot of money, get an independent advice from another attorney, a tax attorney who understands the transactions, and said, look, here's the pros and the cons, and here's what's going on. Because IRS it's published. Basically, they said they're going to disregard that opinion. It's not an objective opinion. They're just trying to sell you on the transaction themselves. A quick thing, the penalty for entering into a tax shelter is pretty significant. It's 50% of the gross income that you receive. That's 50. So if you have an S Corp, the S Corp pays 50%. Each shareholder pays 50%. So you can imagine it's getting pretty close to, it's probably over, over 150% at that point. They're intending to wipe out not only the profits, but to dissuade you from ever doing it. It's a penalty intended never to have you enter in that transaction again. So I'll give you a case study. We had a client several years ago that had an operating company, and the CPA came back and said, I have a way to save you a structure that's going to save you a lot of money on taxes. And here's how it's going to go. They had a manufacturing company. Can't tell you what they manufacture, but just one company with about maybe 10 employees. The CPA says, hey, you're going to open up 2 additional LLCs. Okay. One LLC will be the management company. Another LLC will be the finance company. Each of those LLCs will also open up a pension. And so the management company will get a management fee for managing the main company. And that money will be, most of it is going to be funded into the pension so that it doesn't incur any taxes. And that the main operating company had a huge write-off for an expense. It's a way to shift income to other entities and then to shelter the income through a pension. Well, the IRS disagreed that this was legitimate. They thought it was an abusive tax shelter. They weren't necessarily going after them for criminal, but they were really convinced that this was quasi, it was fraud. I mean, they mentioned that in the report. And they opened up a 5-year audit. So here's another tip. If you get an audit and it's for 5 years, you can be sure that there's some indication of fraud, some indicators the IRS thinks it might be a fraudulent transaction or return. Usually the typical audit is going to be 1-2 years, maybe 3, but not 5. So to defend the company, we have to show 2 things, okay? We have to show, number one, that the company's The respective pensions were not set up for tax purposes. They had an independent business purpose, right? Because you can't just do things for a tax savings. There's a very famous US Supreme Court case, and it's on the tip of my tongue, but I can't remember the exact name of it. But one Supreme Court justices basically said, you're entitled to pay the least amount of taxes. You just can't do it only for purely tax purposes. So if there's no business purpose, and that's a legal term, if there's no business purpose for the transaction and it's purely for tax purposes, IRS is probably going to deny it. The second thing we had to prove is that the pensions, the companies were legitimate and also the pensions were legitimate. And we won on the pension side. So another little tip is if you have multiple companies and you have different pensions and you have employees in different companies, there's a theory, an actual legal theory that says these companies with a common ownership, all the employees have to share in all the pensions. You can't have company one with one pension, company two with another pension, and never have those two pensions share. The employees generally have to be employees of all pensions. And there are some exceptions, but that's the general rule. End of the day, we succeeded. IRS was going to try to assess them $2 million, and they were going to disallow the pension, which would cause the pension to pay 100% tax in a sense. But they agreed that the pensions were valid, and they didn't agree 100% with the management company and the finance company. But we got most of the disallowed deductions to be allowed. So it was a very challenging case. Okay, so how does the IRS select a tax return for an audit? One thing that a lot of people don't know is that the IRS has an algorithm called a DIF score. It's called a discriminant function system score. And all the returns get input in the computer if they're paper copy or the electronic copy gets put in. And the algorithm goes through all the returns and flags returns based on a score. Well, scores the return. If it has potential error, it has a higher score and it's pulled out. Somebody at that processing center physically looks at that return and says, okay, yeah, I agree with the computer's determination. They send your return to the local office where you live. And then a manager, a group manager and a revenue agent, which is the auditor, will review the returns as a group and determine which ones are going to select for audit and which ones are not selected. And 4 years ago, I hired a manager who was formerly with the IRS no longer, and I hired her. She had 30 years experience, and this is what we learned about the process, that not all returns that are selected by the computer or even the processing center for audit are audited, maybe 20%, 2 out of every 10. So they're really looking at the ones that they really believe they're going to win. They don't want to waste the time. Right? They don't want to waste their time on things that are not going to produce revenue and that are not intended to teach people how to be compliant. Because that's truly the function of the IRS, is to collect taxes and to make sure that people are tax compliant. Okay, so some things that you can do, let's see here. I think I missed one thing here, but I didn't put a slide for it. Yeah, I'll just talk about it here. How do you verify some things before your tax returns are filed? So there's a little pro tip I'll give you that not a lot of people know, and even not a lot of practitioners know. Not a lot of attorneys or CPAs know this. You can call the IRS for your business and get a report of all the income reported to the IRS about your business that are 1099 income. So if you, like many business owners, will receive a bunch of 1099s, but maybe you lose them, they get lost in the mail, and then your accounting system is not 100% accurate. You can call the IRS and ask them for what they call an IRPTR report, IRPTR. And I have to say, even some of the people at the IRS don't even know what we're talking about. It's the people that have been there for like, more than 10 years or 30 years, like, oh yeah, I know exactly what that is. So you can get an IRPTR report, and it's a report of all the 1099s that were filed again, for your company by other people, right? So another thing you can do, if you accept credit cards, you should get a 1099-K from your merchant processor. The 1099-K lists the gross receipts that your company received in credit card payments. But there's one problem with it. It reports the gross, it doesn't report the net. And what I mean by the net, if you have any chargebacks, if you have any refunds, those things are not included. So naturally, that 1099-K is going to overstate your income. Now, most of the people are not going to have, more than maybe, I don't know, 5% or 10% of the gross proceeds being returned, but it could be, and IRS does look at that. Many years ago, actually, IRS had a tool. They don't use it anymore because I don't see it in audits. they had for every industry, like we had a car rental company, and they said, look, this car rental companies in the US, or at least in your geographic territory, typically receive, based on our data, 80% of their gross revenue by credit card, and maybe 10% by check and cash, or 20% by check and cash. So she said, well, your 1099K is almost the same amount as what's on your return. So I think you're underreporting income, or your client is, by 20%. So then we had to show her through a bank deposit analysis that almost everything came in from credit card. Nobody rents cars with cash. And nobody will do that, go into an enterprise rental car and say, here's cash. They usually don't accept it. They want a credit card for a deposit and the fee. So if you add your 1099K and your IRPTA report, or all the 1099s you receive, that amount should be pretty darn close to what's on your tax return. It shouldn't be more. If it's more, then you definitely have a problem, and you want to go through and talk to your CPA, go through the bank deposit analysis and find out what's going on here. Why do we report more? And if you have refunds and adjustments to the gross, that's fine. But I'm talking about the top level number, that, you know, line number 1, gross receipts. Some people will net them out. You know, if they have a refund or a chargeback or something like that, they'll net it out in that top number, which then makes it harder to calculate. So I would definitely recommend splitting those two things out. Okay, case study number 2. Let's talk a little bit about that. So common mistakes on a return. One, a big one, which probably applies to some of you guys. You know, you have a business and you also have some real estate investment, and typically people don't make money, and at least in the right, you know, when they first acquire property, they usually lose money. So a lot of people try to offset the losses from all the real estate investments against other income on their tax return. You know, your business, which you're actively involved in, is ordinary income. Your investments, such as your investment in stocks and other securities and real estate, is generally considered to be passive, and you can't mix the two. Passive income is offset with passive losses. Active income, or ordinary income, is offset with ordinary losses. So the general rule is that any loss from real estate is generally considered to be passive. There are several exceptions. You can be a real estate professional. Doesn't mean you have to have a real estate license. But the rule is you have to show with proof that you spend at least 750 hours a year devoted to real estate activities, either each property, or you have to make the election to treat all of your property as one activity, and then it can count. But you got to make the election on your return. And it's really hard. I've had a lot of cases, but the case example we're going to talk about is a guy who owned 7 shopping malls around the United States. And I got involved, like we always do, after the CPA says, you know, I'm going to throw my hands up and look, they're going to assess me $2 million and I need help. So we went in and I talked to the IRS and said, okay, so what's the issue? Well, this guy's claiming that he has all these losses, but we think he's a passive owner. Well, why is that? Well, because he has a management company. Well, yeah. So typically, if you have a management company managing your properties, the presumption from the IRS is you're not managing the properties, you must be passive. Well, I came out with this theory, which I always push to the IRS, as long as it's true, of course, is that you can co-manage. So this guy was co-managing the property, and why I prove that is that he had these shopping malls with big box store companies like Walmarts and Targets, and he had emails. This is where the proof comes in. He had emails between himself and the Walmart leasing executive. When there's a major problem, he would get the contractors involved. Property tax issues, he would resolve himself. So what does he need, a management company? Well, the management company did the mundane task of collecting rent and, you know, dealing with the tenants on other issues. But he gave a limit. He delegated the authority to the management company and delegated to them, but limited to them to maybe $10,000 per issue. So if anything more than $10,000, you got to call me. So once we showed all that, and once we showed the management agreement, then IRS was perfectly fine. It took us about a couple months. In fact, I even got a refund for him. So I think that kind of put a little bad taste in the IRS's mouth. They wouldn't audit him again. But one thing we learned from that is that a lot of people treat the IRS really poorly, and this is something nobody ever discusses. I can't tell you how many cases I have that I come in there and like, yeah, this guy's just, and they'll tell me honestly. I don't have the client on the phone with me. But they'll say, this guy's a real jerk. I mean, he's just impolite. They're not providing the documents I need. I'm just going to close it and I'll disallow the expenses and they can go to appeals or they can go to tax court. We win more cases because of good lawyering, good negotiation, and over preparing. We know all the facts. I know where all the bodies are buried. So I can be honest with the IRS, but it's my job as an attorney to protect my client. It's not my job to give the IRS all the problems on the return. But I have a very fine line because I got to be honest with the IRS. My job is not to mislead the government because that's a criminal issue then. So, but long story short, we win more cases because we're polite with the IRS and we negotiate and we say, basically, look, I understand your position. Why don't we talk about it and let's look at it from a different perspective. All right, I'm going to talk real quick about some other mistakes on a return that are very typical. Unreported income comes up all the time, 99% of the time. You know, 80% of the time, it is actually additional income that people forgot to report. And the other 30%, it's just they don't remember. You know, on your B of A bank statements, it's going to say deposit item $50,000. And you're like, oh gosh, what was that? Was that cash? Was it check? Was it insurance check? Did I get a reimbursement for a claim? Nobody knows. So keep your bank deposit receipts and the supporting documents. It is a pain, but you should do it. And if you're going to be depositing cash, large sums of cash, maybe you have a cash business, that's fine if that's what's typical for your business. But an advertising agency shouldn't be having a lot of cash in their account or being deposited. So if there's a reason you're getting cash, you need to document it. When I get cash, I hate getting cash from clients, but when I do, I send them a letter. Well, when they meet with me to give me the cash, I say, okay, I'm going to give you a letter today and you're going to sign it. You've agreed that you've paid me $5,000 in cash and this is going toward the retainer. So later on, if they claim that they gave me 20,000 and I said, no, it's 10, how am I going to prove that? Cash is not traceable, but I have a letter confirming that with the date and I hand it to them, they signed it. But it also shows it to IRS where it came from, where the source of that money came from. Other common mistakes is not issuing 1099s. This is a big problem in so many areas, and it's not just with the IRS, it's with the state of California. And we'll talk in a little bit about AB5. AB5 is the new law that became effective January 1st of this year that changed the landscape for how we define an independent contractor in the state. And by the way, California is not the only state. About half of all states have this ABC law. And ABC, you know, it doesn't mean that, you know, not all the states follow ABC. Other states might have A and B or A and C or things like that. And real quick, and I know we wanted to get to it in a later point, but has anyone dealt with the ABC law in their business and independent contractors? Is that an issue for anyone? No?
Not at the moment.
Okay. All right, so not giving a 1099, which is very common, or giving 1099s, but not to everyone. The IRS will charge what they call a backup withholding tax. It's a 28% penalty on the gross payment. So if I pay Michael, maybe Michael does my digital marketing, and I pay him $100,000 by check. And say he's not a corporation, so he's an LLC, and I don't give him a 1099, and IRS audits me. They're going to assess me $28,000 penalty for not giving Michael a 1099. The logic behind that is that they're going to think if I didn't give a 1099 to Michael, then Michael most likely or presumptively did not report the income. So now I'm going to pay his income tax. And the 28% basically zeroes out any tax benefit. So either they're going to say you can have your deduction, but we're going to then penalize you. So, I mean, the value of you basically get a deduction for 28 cents on the dollar. So it zeroes out any benefits. So what's the point of having the expense in the first place? On the EDD side, not given a 1099, if you have an audit from the EDD on 1099 contractors, they will penalize you up to 75% of the gross payments because you didn't report a W-2 or a 1099. It's called a worker information penalty, and they have an additional worker information penalty. So the work information penalty is like, maybe I paid Michael $100,000 and I give a 1099 for $80,000. So I'll get a penalty on the $20,000 because it wasn't accurate. The additional worker information penalty is where I never gave him a 1099 in the first place. And the combination of those two could be up to 75%. We've had cases where the penalty is higher than the tax in California for an EDD audit. So it's a really important thing. Go through with your CPA, your bookkeeper, and I can't tell you, I don't care if it's a $50 million company, a $100 million company, or a $1 million company. Every single company that I've dealt with has had this issue. I had a company, there was a nurse registry in California and they were like a $10 million company. And I found, I don't know, maybe $2 million of total payments that were not properly reported with a 1099. And that would have been a huge problem for them. So there's ways to fix it, but it's a definitely a big issue. Okay, other red flags on your return that maybe can signal a criminal investigation, because a lot of people don't deal with criminal investigators, and you never want to. But if you do, you got to call me. If you're contacted by an IRS criminal investigator, that's a pretty good sign that they're, and I had a client that they knocked on his door. 2 criminal investigators usually come in a pair. They knock on your door at your home. They know your address. And they say, hey, we just want to ask you some questions. And you might say, well, is there a problem? No, not really. We just have some questions for you. And one of my clients, they actually said, hey, do you recognize this check? Oh, and hey, is this your tax return? So when I called them up and I said, look, is this person that you're talking to, that my client, are they a witness or are they a target? A perpetrator? And a lot of times, well, right now they're just a witness. So I said, well, if they're a witness, why are you asking about their tax return? Because it's not, as a witness, you want their testimony regarding somebody else, not about themselves. So you got to be really careful. You're always entitled, whether it's a civil or criminal audit, whether it's federal or state, you're always entitled to have an attorney or representative there. Really important to do. If you receive large amounts of cash, or wires, all that gets tracked through an IRS or Treasury has a system, all the wires go in and out. And if they eventually, and they're all recorded, right? They may not do anything with it until you pop up on their radar. I'm like, okay, we want to check Michael out. I'm sorry, Michael, but he's using it as an example.
Give it to me.
They're going to say, hey, well, let's audit Michael. He has, unusual amounts of cash being reported. And then they pull the database and see there's a lot of wires coming from China and Hong Kong and being bounced around the world. So, just make sure that you can address it. And if, by the way, here's an interesting thing. If you receive a lot of cash, at least $10,000 or more from a specific, at least one person or business entity, you have to file a form with the IRS. And you have to give the form and a letter to your payer, your customer, that you received it and you report it to the IRS. And if you don't, it could become a criminal issue, and you'll have what they call a Bank Secrecy Act agent come to your office or your home and say, we've noticed a lot of cash transactions and you didn't file it. The penalty for not, at least at the time, they might have changed it, the penalty for not filing those 2 forms is $200 per transaction. And I had a client who had 10,000 transactions, with different POs, and each of those were cash. And when you put them all together, there's a lot of transactions that he didn't, more than 10,000 per customer. That could have been a lot of money and potential criminal, but we showed that it all originated from the same order. It was one order that was split into a bunch of smaller orders. So, we showed them that and they backed off, but it's a really big issue. Okay, let's talk real quick about AB5. That's always a hot topic. This is a test about whether when you hire a contractor, okay, when I'm talking about contractor, it's anybody who's not an employee. You're either hiring an employee, which gets a W-2, or you're hiring a contractor, which is everybody else. It's one or the other. So in other words, there's some people many years ago say, hey, you know what, I'm going to move to Nevada, open up a corporation there, and I'm going to be a contractor. I'm going to be a 1099 contractor for my company. Well, you can't do that. Why? Because any officer of a company is automatically an employee under federal and state law. So you have to give yourself definitely a W-2 and distributions from the company. So there's 13 factors. These were the old test that applies up through 2019, December 31st. So these are services performed up until December 31st of last year. They're going to judge or analyze whether the person was a contractor. Okay. The new test is a 3-element test. Difference between a factor and an element. Factors, imagine the scales of justice. They're going to say, well, do I have more factors that are tipping toward contractor or more factors tipping toward an employee? With elements, you have to meet all of them under AB5. It's a yes or no. And if you don't satisfy all 3, your worker is automatically an employee. Where the audits normally start from the state of California is somebody files for unemployment, and that's very common right now, and I'm getting a lot of calls from different businesses, said, hey, I had no more work because I had to close my office down, and my contractor filed for unemployment because they thought they can get benefits. Well, up until this year that was true, but now contractors can also get unemployment benefits under certain circumstances. So this person, I had actually 2 audits, a company that's in Boston that hired somebody in California as a contractor. And they said, well, the person filed as an employee. They said they were an employee. They're entitled to benefits. And I hate to tell you this, but guys, the EDD not always, they tend to side with the employee. This state is very much presumptively treating workers as employees. Their MO is to go into the audit and to hold that everybody is an employee unless you prove them wrong. And that's just the way it is with EDD. They will tell you that if you ask them. So now you have to backpedal and go, okay, where's all my evidence to show that they're a contractor? It's a lot of work. So the 3 elements real quick is that you had no control over this worker. And that's a very fuzzy thing. It's not like a 0 or 1 like binary code. It's, well, how do I show I didn't have control? Did the guy wear a name badge with my company's name on it when he visits clients? Is he wearing a t-shirt, a logo? Is he driving a company truck? Does he have any tools? One really important thing for any people who do construction, if you hire a subcontractor and the subcontractor is doing licensed work or something that looks like licensed work and they don't have a license, they're automatically an employee. And EDD and CSLB, right, the Contractor State Licensing Board, are driving to different job sites and finding and just walking up and interviewing people and say, hey, you're installing bricks, you're laying bricks and putting concrete in. Are you an employee of the general? No, I'm an independent contractor. Oh, cool. What's your license number? Well, I don't have a license. Cool. And they write you up. And then what happens is CSLB has a division called the SWIFT, I think it's called SWIFT division, where they write up a report and they send it to the district attorney's office in the city where they're located. Automatically in San Diego, all the cases get referred to the district attorney for potential criminal prosecution investigation. And we had such a guy who had 2 workers on site doing irrigation and a bunch of other gardening things, but it was really licensed work. And the 2 people said, hey, we're not licensed and we're contractors. And they said, great. So they wrote up a report. They referred it to EDD. It got opened up on an EDD audit, and we were able to shut it down so there was no criminal referral. I think the mandatory fine is about $10,000. And trust me, that's the least of his concerns, because what we found out, there was a lot more than 2 contractors. So, and it's only because we went through bank statements. He thought he only had 2 people over the last several years. It was quite a few. Anyways, the second element is that the worker performs work outside of the hiring company's core business. So Michael does digital marketing. If Michael hires a videographer, there's a good argument I could make that those are 2 different industries, right? Because Michael is doing digital marketing. He doesn't have the skills, the tools, the equipment to go hire a cameraman, a sound mixer, and all the other, a voiceover, all the other things. I could argue those are 2 different. One that might be a little bit closer is a plumbing company. So say you have a plumbing company and you get a lot of work now because a lot of people are at home and there's a lot more damage. And so people are calling plumbers and you don't have enough people on staff. So you hire some contractors just to help with the overflow work. Well, in that case, the plumber who you hired as a contractor is doing the exact same thing as the business. You kind of lose on that element. But what happens if your plumbing company is residential plumbing and every so often you get a plumbing job that's a commercial plumbing? I can definitely argue that those are 2 separate functions because commercial plumbing work is entirely different than residential. Different skill set, different specs, different requirements, regulations. So those are 2 different things. And one might be in a high rise where you have to work with a management company. So that's some distinction about being outside of the core function of the company. And the last one is the worker has an independent trader business and that they're doing work in that trader business. So if you hire a sole proprietor, you know, Michael has a business, but say that he didn't, say he was just working out of his house, like a lot of people are doing today, and they don't have employees, and it's just them. How do I prove that Michael is a real business? Well, I'm gonna have to see, does Michael have any other customers? If he doesn't have any other customers and I'm the guy, his only customer, much harder. So we do have a separate company. So I am a law firm. I have a separate company called Clear 1099. We run business background reports. It's an intelligent report that goes through social media, does business verification checks with public records for corporations and DBAs and everything else. And we create a profile per worker and pitched that to EDD, said, look, here's a write-up of a full page of facts to show that this guy is a contractor. He has a Yelp site. He does advertising on some other websites. He may not have a website, but there's a lot of stuff that he's trying to get business out there. He has commercial insurance, and there's ways to find this stuff out. And if he doesn't have a corporation, does he have an EIN number? I can verify that. So these are a lot of things. These are the things you really need to do for your existing contractors, as well as for the people you're looking to hire. AB5 is estimated to produce $7 billion of additional revenue. Okay, that's a lot of money. That's why the state's after this. They want more money. And currently they're running at a deficit. So you can be sure when the economy sort of springs back maybe next year, they're going to have a great list of companies they want to audit. From all the people, all the workers who came back and says, I'm a contractor, I was treated as a contractor, I'm really an employee. Okay, so we talked a little bit about some of the things you can do. We have the clear 1099 report. Things not to do. If you are concerned that your worker, a worker, or multiple workers are not contractors, don't convert them mid-year. Anybody have an idea why we won't? Sorry, it's my fax machine. Anybody have an idea why we don't want to convert a worker mid-year?
Because won't they treat them as an employee for the whole year?
You're getting close. Anybody else? No? All right. If you convert somebody mid-year, anytime but at January 1st of the year, that worker legitimately, if they worked and earned income, should get both a 1099 and a W-2. Well, how's that going to look to EDD now? They have both. Well, which one is he, a 1099 or a W-2? That is definitely a red flag for EDD, and they look at that. They can pull your 1099s and your W-2s from IRS and other sources. So trust me, that's a huge problem. If you have the ability to wait until year end and start on January 1st and convert that worker over, better. It doesn't eliminate the issue, but it's better. And then also the second thing is don't have different people performing the same tasks. Don't have a 1099 contractor doing the exact same thing that one of your employees is doing. Unless you can show they have entirely different functions, because then they're going to say, well, this person does the exact same thing. These two people do the same thing, but you're treating them differently. You're classifying differently. So, you know.
John, on that question though,
yeah.
For us, designers would easily be something in this category, right? So I have a designer, they are busy. I need to bring on a contract designer for a short period of time to help out on this project, right? So that's how we do it, right? And technically, yes, they do the same thing, but it's a little bit of overflow, and I don't have enough work to bring that person on full time, hence the contract side of the world.
Yeah, so that's a common problem. What I would try to say is give them different duties. And so like for your industry, which I know fairly well, maybe the contractor that you bring in is to work on an account in an industry that your firm just doesn't specialize in. You know, maybe like a pharmaceutical company. We need this guy who has a lot of pharmaceutical company and used to work for Illumina, and he's going to help us do blog writing because it's a very technical skill. There's a lot of things when you write a blog for a pharmaceutical, for a drug, on how you're going to talk about the effects, you know, things like that. If you can specialize that contractor, a lot easier. Again, never a complete defense, but if I can show that my typical employee blog writer is not specialized, they don't have a science background, they don't have all these other things. This guy is a specialist. For me, as a law firm, when I hire, we had a huge case with IRS, and I hired another attorney to give me an opinion letter, and he had his own firm. But let's say he was an LLC, but let's say he didn't. I could argue that person's a contractor because he was dealing with ESOPs and pensions. So I hired him because that's not my specialty. Yes, I do tax, but that's such an esoteric thing. So I hired him for that. And I can argue that that's a specialization that I don't do, just like the plumber, residential versus commercial. Find a way to bifurcate them, show them, distinguish them as different. If they have other clients, have an open conversation. Look, if I treat you as a contractor, I need to know a little bit more about you. Do you have an EIN number? Do you have other clients? Do you advertise? Do you have a Yelp website? And some of the things you can do, you can have them get an EIN number before. And I had a company, before they would ever enter anything in their AP system, they'd say, okay, we're going to put you in the AP, but before you do any work, you've got to get an EIN number, proof of insurance. In that case, it was applicable, maybe not so much in yours, but you also can't be reimbursing these contractors, Michael. I'm not saying you are, but you can't reimburse employee or contractors for tools. You have to have software and things like that. They got to do that all on their own. That's a separate business. That's why they call it independent. It's separate. They got to show they're separate. Okay, and the last one we talked about a little bit, things not to do. Don't hire people to do licensed work when they're not licensed. Construction is a big one, and that does turn to criminal. Tips to respond to EDD. Definitely before you even open your mouth, because a lot of times when there's an unemployment claim, they're going to call the owner and they're going to interview that worker, and they're going to ask you for information. They're not there to help you and say, well, let me try to help Mike to prove this person's a contractor. No, they're going to ask you questions that establish a person as an employee, because it's another company on the hook, another company we can audit. So make sure you go through your accounting records, make sure you have all your 1099s, make sure you've done your analysis, just like we went through today, to determine whether they're really a contractor. And if they're not, obviously hire an attorney to build a profile and maybe run a report to show that the person that they are investigating who filed the claim is really a contractor. And we have exactly that case today, and we did that work, and it's still a challenge, but that's what we do. Real quick, last thing, tips to minimize taxes, C Corp versus S Corp. If you have a C Corp and you've always been a C Corp and you're going to have an exit strategy, or you want to open up a business, you're going to pay more taxes with a C Corp, right? So the corporation pays a tax at the corporate level. And when you take money out, you're going to pay a second level of tax for distributions. But the beauty of the C Corp is you get what they call a qualified small business stock exemption. When you sell the company, there's a potential to have up to 100% of that capital gains upon sale exempted from federal tax. State tax, there's no such exemption. Federal tax, there is. There's a lot of other requirements. You have to be in a certain industry, below $50 million of assets. I can't remember all the requirements, but we went through this analysis multiple times. So that's the C versus the S. If you have an LLC, or if you have an S Corp and you're saying, gosh, you know what, as an S Corp, I'm required to report some wages on the W-2 and I'm paying payroll tax, the company's paying payroll tax. If you have an LLC, you're actually prohibited from paying as an owner or as a managing partner by paying yourself on payroll. They actually had a company who was audited who was doing that, and they removed the payroll. They got a refund. So as an LLC, management / owners are not required, and they don't want them to be on payroll. And last thing is maybe a retirement plan to defer income. If you're making a lot of money and you want to defer some income, a pension, a retirement plan, it might fit. I don't do that, but you can find, and within EO, there's tons of people who do that, who can definitely reduce the taxable income. So hopefully that was helpful. I'm sorry we went a lot over, but I don't know if anyone has any questions.
Well, first off, John, thank you so much. Lots of stuff in there. I will still, you know, for me, that kind of contractor overflow work, it will be a big deal for me through my stuff. But yeah, anything that I can learn to kind of keep the tax man off my front door, I'm totally excited about that. So
thank you. Yeah. So I don't know if anyone doesn't have any questions. I mean, we're happy to answer them. If anybody wants a copy of the presentation or has any specific questions, they can also email me. I'm on the EO website, but if you don't mind, Michael, maybe you can share that with other people. If they have any questions, they can email you.
Hey, John, I got a question for you. It's Stefan.
Yeah.
You'd mentioned about for requesting 1099s from sole proprietors as well as businesses you're working for or working with as well, I believe. Can you just talk a little bit more about best practices again for who we should be requesting those 1099s from, and if we find out that we've missed anybody in the past, what we want to be doing?
Yeah. Now you're talking about people who are paying you and should be giving you a 1099, or people that you pay? People
that I pay.
Okay. So the rule is, and there's another element to it that a lot of people don't consider. If it's over $600, you're paying for services, not product. Because if you're paying somebody to produce like a cabinet for you, and or something you can show there's a physical product, then you're not required to give a 1099. Over $600, I'm not sure we just described that, over $600. If you pay them by a credit card, you're not required to give them a 1099, by the way. A lot of people don't know that, because that company, as we talked about earlier, is already getting a 1099K from their credit processor. So they're going to double count the income. So if you pay people by credit card, you're not required to give them a 1099. And lastly, you're not required to give a 1099 to a corporation, but an LLC is not a corporation for tax purposes. It's a partnership. So if you have like a landlord, which real estate is normally held in an LLC, I give my landlord a 1099. because it's for rent and they're not a corporation and it's over $600.
So if I'm doing work with a digital marketing agency, and for everybody else, I have an e-commerce business, but if I'm doing work with a digital marketing agency and they're an LLC, then I would want to issue them a 1099.
Yes, for sure.
Okay.
And one really good practice that I can borrow from another company, a really large company, before they were going to pay me, they said, hey, we need you to fill out your W-4 and you got to give me your EIN number. Because what happens is a lot of times, you know, we're all guilty of that. We get to the January, whatever date in January, and we're running our 1099 report in QuickBooks or accounting system. We're like, oh my God, there's a bunch of EIN numbers I don't have. So then you got to make the call to like 30 people or something to get their EIN number. And if they're not available, then what do you do? So before I put them in my AP system, before I'm going to hire somebody and I sign the contract, I'm going to get their EIN number. So like I'd ask Michael for his EIN number, regardless if they're a corporation or not, regardless if you have to give them a 1099 or not. It's good to get it at the very beginning because things might change. Maybe Michael is going to convert to an LLC, or maybe you misanalyze something and now you're going to need it. So it's good to get it ahead of time before you issue any checks and at the time you hire them.
Okay, that's great. I'll make sure to do that. Thank you.
Yeah. Sorry to pick on you, Mike.
And with that, that wraps up our 12 o'clock. So we want to make sure that I'm going to be posting, so John can send me this presentation. I'll be posting it inside the EOA San Diego Facebook group. And then obviously Jen will have access to the link for the recording as well. I'll put John's information in there. If anybody wants to reach out, connect, chat, please do. And then John, I know that we got a couple EO members on here as well. So I'm sure that those, that Jen can help us post anything that we need to inside your guys' Facebook group, since I don't have access to that. So, okay, but thank you so much. I appreciate you being my first official, you know, inaugural Lunch and Learn kickoff member for this year. I learned a lot of stuff today. I really appreciate it.
Yeah, my pleasure. I love doing this stuff and educating business owners. So thanks.
Thanks, John.
Thanks everybody for coming today. I really appreciate your time and energy.
It's a pleasure. Keep it going.
Thank you.
All right.
Thanks, Fred.
Well, thanks everybody. Bye.
Well, I'll call you now. Can I call you?
Yeah, sure.
Okay, I'll phone you now.
Okay. Bye, guys.
Bye, guys.